Hey, good afternoon, everybody, and thank you for your time and attention. Just to make sure that I don't kind of confuse things, really the guy who has the tremendous track record is my boss, Neil Woodyer. I'm here in his stead. Unfortunately, he couldn't be here because of some personal matters, but he would have certainly been very excited to be here today. Aris Mining is a Canadian gold mining company with operations in Colombia. And it is really a story about transformational growth in the near term. We have two operating assets in Colombia, Segovia and Marmato, and these assets last year produced 226,000 ounces. And we are right now in a transformational growth period where we take the production from these assets to 500,000 ounces by the second half of 2026. And that growth is fully permitted, fully funded, and currently being executed on. And that will put us in a position to at least double EBITDA from $150 million on an LTM basis to at least 300 by 2026. In addition to that, it's not just near-term organic brownfield growth. We also have two projects in our portfolio, Soto Norte and Toro Peru, for as greenfield development projects for longer-term growth. And especially Soto Norte stands out as a world-class asset, having 8.5 million ounces on a 100% basis. 8.5 million ounces in indicated resources at a resource grade of 5.5 grams per ton. And Toro Peru is a meaningful asset too, 5.4 million ounces in measured and indicated at 1.5 grams per ton in Guyana. But when you think about it from a ranking perspective, laser focus on delivering the expansions of Segovia and Marmato, and then Soto Norte is next, and the Toro Peru ranks last. But it's not just about growth from a production perspective, it's also about growing the resources and reserves, and we've been very successful at that last year. We've grown resources by 114% and proven and probable reserves by 75%. And probably most importantly, all of this is underpinned by a very significant resource base, 9.6 million ounces at our operating assets and 9.7 million ounces at our development projects. And it is not just very significant in terms of ounces in the ground, it's also high grade. And as you know, grade is king when it comes to mining assets. At Soto Norte, we have a resource grade of 14.3 grams per ton and a reserve grade of 11.6 grams per ton. So this is the second highest grade gold mine in the world. And we have also very high grades at Soto Norte at 5.5 grams per ton. And that is underpinned by strong capitalization. We have $147 million of cash on hand as of the end of last quarter. We have ongoing cash flow generation from Segovia. And we have a team that has a track record of success, having done it multiple times before. As Tom said, our company is led by Neil Woodyer, and Neil Woodyer created and led Endeavour Mining, and under his leadership, it grew into a multi-billion-dollar market cap company before he handed over the reins to the next generation of management. And then he founded Leia Gold and grew that into a $750 million market cap company before merging it into Equinox. And so this is the third gold mining company that he's building. And if he were here today, he would tell you that if he compares Aris Mining to Endeavour and to Leia Gold, kind of 3 years into the company build, this is the strongest asset base he's ever had. And the other thing is, it's not just about him. I mean, he's first and foremost a team player, and he has kept his team together for a very long time. I mean, I'm fortunate enough to have joined the company recently, but the management team that is working with him has, for the most part, been working with him for decades. Just to put like some of those numbers that I just mentioned into perspective, I mean, we are a junior mining company. Today we have a market cap of about $640 million, right? And yet we are ranking already near the top the peer group as we define it in terms of mineral resource endowment, right, with 20.1 million ounces in measured and indicated, and an incremental 9.1 million ounces in inferred. And we are also climbing the ranks in terms of our production profile. And as I mentioned, we're growing production by more than 100 or almost 100% from 230,000 ounces, which is the midpoint of our guidance for this year, to 500,000 ounces by the second half of 2026. And what we're trying to show with that graph on the right is the re-rating potential that we think our shares offer. When you think about some of our peers who produce 500,000 ounces today, such as Eldorado or Lundin, their market cap is measured in billions, right? And we're at $640 million today. Maybe a few words about Colombia. Colombia is, I think, a very exciting place for us to do a business in. Colombia is endowed with very high-grade gold deposits, and quite frankly, it's been underexplored. When you think about the mining boom in its Andean neighbors, Peru and Chile, in the 1980s and 1990s, that didn't happen in Colombia. And yeah, for obvious reasons. But what that led to is that a fraction of the capital came into the country in order to explore for deposits. And the same geological events that have created these highly attractive deposits in Chile and Peru, those geological events wouldn't have stopped at the border to Colombia, right? So we think there's tremendous potential there. And despite us only being a junior mining company, we're already the largest gold mining company in the country, right? So we're really at the vanguard of an emerging gold mining industry. And for those of you who have not been to Colombia, it's a country that has strong rule of law, a really well-crafted constitution. It has a well-developed infrastructure, like very good airports, roads, power infrastructure, and it does have a skilled workforce. So we feel quite fortunate to have strong exposure to Colombia. And as you can see, like our two operating assets here on the map, Segovia and Marmato, they're highlighted in yellow. We own 100% of each of those, and our operating office in Medellin is right in between the two. And then Soto Norte, we own 51% of. Our joint venture partner there is Mubadala, the sovereign wealth fund out of Abu Dhabi. And then we have Toro Peru and Guyana. And clearly Guyana has been in the headlines lately for some big mining companies showing interest, and obviously also like the whole oil and gas exploration that is a game changer for and development that's a game changer for the country. Maybe just zooming quickly in, I wanted to put like that grade profile at Segovia into perspective, and that's a benchmarking that we have done. And as you can see, based on the reserve grade Segovia of 11.6 grams per ton, Segovia ranks as the second highest grade gold mine in the world, only ranking second to Makassar. Segovia today is our key cash flow engine, and we're expanding it by 50%. So last year it produced about 200,000 ounces at all-in sustaining cost of $1,250 per ounce, and generated meaningful free cash flow of $44 million on an LTM basis, after tax, after growth capital. For this year, we've guided for 200 to 220,000 ounces at all-in sustaining cost of $1,225 to $1,325 per ounce. So an all-in sustaining cost margin of $1,000 in this gold price environment. And you know, this asset has been around for a long time. It's been quite steady in its production. Since 2018, it has produced 200,000 ounces on average. And since 2011, 1.7 million in aggregate. And today we're expanding it by 50%, and we're doing that by way of debottlenecking the processing plant. So the bottleneck of the processing plant is milling capacity, and we're installing a second ball mill there in order to lift production capacity from 2,000 tons per day to 3,000 tons per day. And what makes this project so attractive is that the capital budget of that is only $11 million US. So it is incredibly capital efficient and results in very high returns on invested capital for us. We expect to deliver that project by early 2025 and then have a ramp-up period of about 6 months to get to the 300,000 ounce run rate production. This is just a quick visual of what we're building. When you look at the infrastructure in purple, that is what we're adding to the plant. And you see effectively 2 modules to it. One, a second ball mill, which is the smaller one of the 2 that you see there in the top left-hand corner, and then a new receiving facility, that is the one in the bottom left. And I think that's an important segue, because that receiving facility is one where we take in the ore from our contract mining partners, and that's important to understand. It's integral to our success in the country. As you know, Colombia has had a history of, or a centuries-old legacy of artisanal mining. And there are artisanal miners who have come out of the shadow economy into the real economy and be properly formalized and legalized into contract mining counterparties. And those CMPs we're dealing with. And they deliver today about 40% of ore feed to our Segovia processing plant, right? And when you think about it, you maximize the economics of a processing plant if you max out throughput capacity, provided you maintain the high-grade profile of the ore feed. And the ore feed that we get from our contract mining partners is high grade, right? So basically, we're spreading the fixed costs over more ounces, making every ounce more profitable. And so this partnership is cash flow enhancing to us. But it is not just cash flow enhancing to us, it is also mutually beneficial to our counterparties. And the CMPs benefit from it, because if they were to process the ore on their own, they would get to recoveries of 50% or less. At Segovia, we have a recovery rate of 95%, right? So we're making the pie that much larger. And whenever you create a scenario like that, it's very easy to design an outcome where both parties are much better off, right? So the contract mining partners are better off financially. And they are now also part of the real economy, so they benefit from social benefits as well as access to the banking system and so on and so forth. So we're uplifting an entire community. And the government, as another constituency who benefits from this operating model, likes it because it increases tax revenues to them, right? And lastly, the environment benefits because if artisanal miners process ore, they typically use mercury to get the gold out of the rock, right? And then they harm themselves, then they dispose it off into river streams for the most part, which pollutes the environment and hurts the host communities, right? And so by us taking care of it, there's 0 mercury involved in this, in processing. Segovia is a state-of-the-art processing plant. And we're producing a gold and silver doré and a zinc and lead concentrate byproduct, which results in very clean tailings, right, that come out at the end, and we store it in a dry stack fashion. So what I'm trying to get at is there's a tremendous amount of environmental damage mitigation by us taking care of the processing as opposed to the contract mining partners, right? And so this is really a business model where all 4 key constituencies are better off, and that goes a very long way in terms of safeguarding our license to operate in the country, but also unlocking opportunities. It's been integral to kind of getting it's been a key component in our license application for Marmato, where we're looking where we're building the lower mine and where we're looking to replicate that model in terms of collaborating with contract mining partners. Maybe just briefly to wrap it up, at Marmato, today it's a marginal asset, produces 25,000 ounces at high all-in sustaining cost, right? Barely cash flow break even at these elevated gold prices. And that's because we have a very narrow vein structure in the upper mine that we're currently operating. You see that on the left-hand side and like the upper area. What we're building is the lower mine, and the lower mine is going to target the porphyry mineralization that we have at the bottom. And that will allow us to be very, very profitable by way of mechanized bulk mining. And we expect all-in sustaining costs of a little more than $1,000 per ounce over the life of mine. And the life of mine is 20 years. This asset in the first few years will produce 200,000 ounces a year between the upper and the lower mine combined. And so we're really transforming this asset from a marginal asset in our portfolio today to a true cornerstone asset. Right. I know I'm beyond time, so I'll wrap it up here. But I appreciate your attention, and I think this is exciting considering this is very kind of near-term growth. Thank you very much.